Tony Greer, welcome to the show. Thank you so much for coming on. How are you today?
I'm great, Chris. How you doing?
Doing great. All right. So this is a nutrition show, um, and I have with me Tony Greer, who is a trader, macro trader for over 30 years, regular on the Real Vision Daily Briefing, editor of the Morning Navigator. Tony, I have you on because I'm doing this series on rising food prices. And you're actually partly responsible for my awareness of this. I mean, everyone is aware of food prices going up. That's been going on for a while. But you had interviewed Doomberg last year on Real Vision, and that put Doomberg on the radar for me. And they had a recent article, "Farmers on the Brink," where they are, not joyfully at all calling for the potential of a global famine. Probably there won't be like severe availability shortages in the United States, but like very likely scenario could be prices go much higher here, and people in the developing world actually do, in the worst case, starve. And I'm trying to understand the causes of it, and I know that you, as a macro trader, were quite early on the commodity trade, and so I'd like to have your perspective as a trader, both in terms of the possible effects of the commodity trade itself on amplifying those food prices, but also more importantly, what the signals that you used that where you were able to get in on that trade. Can we use market signals like that to try to help us regular folks who just want food understand, is this going to get worse, for how long, and when's it going to start turning around? So my first question for you would be, when did you first get into the commodity trade, and what were the signals that you were looking at that got you into it?
Oh man, so I first got into this, meaning
in this cycle.
I would say, Chris, this was a bull market that I was sitting there waiting for, quite honestly. And, I kind of had been waiting for a bull market in commodities. And then the lockdown came along and obliterated the price of all the commodities and gave me a chance to buy them extremely cheap with a really strong bet that this lockdown experience of the global economy was something that was never going to happen again. I think that a lot of the things that, caused the commodity trade to continue to work, came sort of after lockdown and things like that. But, more specifically via the Biden administration, really amping up on the carbon neutral trade, and Europe, who have already been stepping on the gas of the carbon neutral trade and trying to, get all of their big industrials to, at least hedge their carbon footprint. So I guess I was waiting for this bull market. And when energy prices got so absurdly low that they went negative, if you remember that, because people have cargoes that they had to literally get rid of because they weren't being burned because the economy was shut down. So when we started kicking into that, surplus of physical oil stage, is when I started getting my ducks in line for saying, okay, we're not going to be able to buy oil at $5 or $10 a barrel forever, because we're eventually going to restart the economy. And so all of the other commodities were cheap as well. And if you understand the commodity markets, that, energy is 30% of the cost of harvesting grain, and it can be up as much as 40 and 50% of the cost of mining. So, when you know that much, you say, all these other commodities are cheap as well. So let me see if I can get exposure to them while we're at this, historically unbelievable point in time where they've gone to levels that we haven't seen them trade. Some commodities we never saw trade in history, like crude oil, down to that price. So with that opportunity, that was my signal to get in and start collecting some exposure in a very serious way. And then obviously, as the economy started coming back, we started loosening up restrictions, et cetera, et cetera. They rallied off of the lockdown lows. So that brings us sort of to the next phase, I would say, of the trade, which is, the Biden administration, which has been, very, very hard on fossil fuel producers. They canceled the construction of the XL pipeline, which was a great way for us to get light sweet crude from Canada so that our refiners could crack that into products, both, jet fuel, gasoline, heating oil, et cetera. With that being canceled, that had to first be priced into the markets, and that caused oil prices to go higher right away. I mean, you can draw a straight line to election day. Just knowing with the market knowing that Biden was going to fulfill the promises he made of ending drilling, and so that's deeply affecting the markets now. The difference, it's really changed the face of the markets with the administration's posture. They've canceled leases that our exploration and production companies signed up with on federal lands to drill for oil or frack for gas. And a lot of Obama judges during the Biden administration have gone ahead and canceled those leases. So essentially telling exploration and production companies like Exxon, like Chevron, these places here that you thought you were going to put your rigs in, forget it. So you can't drill there, right? So that changes the complexion of the supply side of the energy complex. And then we kind of have to roll into a discussion of the natural gas story, because that's where all of the intensity hits the farmer, really. Because as you know, natural gas is so important, number one, in baseload power, because that's generally where most utilities are generating their baseload power with natural gas. But also it goes into the making of fertilizer. So it's really important. Natural gas creates ammonia with, I don't really know all the chemistry, but with natural gas, you can create ammonia, which goes into fertilizer. What's gone on with the price of natural gas going from $1.50 to $6 per million BTUs is now the price of ammonia and fertilizer is 6x to 8x times the cost that it was a year ago. Right. So now this is something that all farmers have got to figure into their calculus. In addition to the oil price going up, driving the grain prices growing up, which is being driven higher by natural gas prices and ammonia prices. Obviously now propane prices have got to go higher too. And propane is the number one fuel farmers use for drying their crops. So now we've got all these input costs hitting farmers at these crazy, crazy exorbitant levels. And that's really what's going into the heart and soul of the higher food costs, Chris. So I don't want to keep going too long without giving you a chance to check in and make sure that we're going down the right path.
That's great. That's great. And I think, one of the things that chain of events brings to light is the time horizon distance of the food price versus the fuel price. So your fuel is, before the fuel, so the fuel is like used in the tractors and irrigation systems and the drying systems, like you just mentioned, but also the fuel's used to mine and refine minerals for fertilizer, et cetera, et cetera. And so then that affects the growing season. Then you grow the food. Then we got like 3 to 6 months of growing. Then we have like a 90-day store of food globally. And so we're looking at, at least, I don't know exactly what all those lengths of time are, but it seems like from fuel to food price, as long as fuel prices remain high, you have at least a year or a year and a half of high food prices after that. But does that kind of line up the way you think?
That's exactly right. And Chris, what's even more concerning about, there's a couple things that are very concerning about this particular commodity rally. And it's that we're going into it with particularly low levels of storage and low warehouse stocks of many commodities already. Right. So at the heart of the matter, at the heart of the issue in the fossil fuels, we've got, we're very much in the sort of historic low ranges of oil inventories at Cushing, Oklahoma, for example, which is the delivery point that the local exchanges trade off of. So if we're at low delivery points there, that means that the exchange will reflect very tight markets, right? So that kind of makes them what we call backwardated, where the curve is such that the front months are much more expensively priced than the back months. And that is due to people waiting to sort of, that means where you're driving up the cost because people are willing to pay more now to store it for fear that the price will go up higher later. So that's a dynamic that you should keep an eye on. Within the natural gas story now, for example, in Europe, they've got excruciatingly low natural gas storage. They almost had a real scare last winter where, I don't know if you saw, but the price of natural gas went to basically the equivalent of $60 here, right? So it's around $5 to $6 now. It traded to a range of roughly a $60 equivalent within the Dutch TTF contract, which is a European delivery contract. Now, what does that do? It exacerbates the farmer's problem a lot more, right? Because those farmers are still dependent on local fertilizer. And so that price has just gone completely out of whack, / probably not worth making the fertilizer anyway, right? So now you're going to have production halts of certain commodities that producers know that their customers won't pay the end price for, right? So now when you have reversing those production cycles in commodities, that's another thing that you have to be concerned with, because a lot of those don't restart very easily, right? So that's something to consider. So that's why, you see that lag between rising energy prices and rising commodity prices and everything like that. But the problem right now is really, really serious as we head towards, we're going to head first into driving season, but we're now going to head into another European heating season where if they don't expand their storage, they are going to be really, really at risk of freezing, right? And if you've got the risk of freezing and the risk of not feeding your population, we're running into, you have to at least consider the probability of a potentially really, really heated situation occurring.
You're talking about in the winter, like you're talking about the back end of the summer?
Yeah, I'm talking about exactly the back end of the summer. Now, I would imagine, we've already seen, they're protesting over COVID in Shanghai. They're protesting over there not being food in Peru. They're protesting over 20% inflation in Sri Lanka. And, these are the sparks right now that are just catching fire, because another situation is going to be, there's going to be another, Arab Spring situation. I would imagine, there's going to be African countries that are going to be starving for grain, that are, number one, not going to be able to afford it at the prices that it's trading, or number two, not going to be able to get it from Russia. That's going to be where the Russia export to Africa is going to cause a major problem, because a lot of companies are boycotting Russia's production. Or if Russia calls for a ban on exports of their wheat, a lot of these countries are not going to get the supply that they need, and it's going to be an absolute disaster. So a lot of this has got to get figured into the picture. We have a similar situation going on here, just not as extreme yet, because we've got better energy infrastructure, but we've only got better energy infrastructure now because the Biden administration just got a hold of it a year ago. And they continue to really, really put the clamps on drilling and investment. And that's going to only make it worse over that. I would imagine they have plans to make it much, much worse for domestic producers over the next several years. And I would start planning on, $8 to $10 gasoline in the US, I would imagine, pretty short order.
Yeah, and even though a lot of this other stuff with rampant inflation and food availability problems is not in our country, it is a global market, and so if people can't get food elsewhere, there will be a lot of competition for the food that is available here, so that should drive the price up even higher here, right?
Absolutely.
One thing I'd like to get your take on is what about the commodity trade itself? So I interviewed Michael Howell earlier this week, and we talked about how the money supply went up 42% in reaction to COVID, and liquidity injections into the market drive up the prices of assets, all assets, but especially if you look at the stock market, he has like a near perfect correlation with the S&P and the liquidity injections. Mm-hmm. And so, you talked about being really early when the prices of everything went down to like practically zero. But it seems now that there are a lot of people calling for investors who have all this, inflated assets that now might not be so inflated anymore, or might be at risk of dropping, that a lot of that money is going to move into commodities, in the same way that some of us regular folks who just need to buy food are thinking, geez, maybe I should stock up on something. If everyone goes and panic buys at the store, that drives the price of the food up at the consumer level. But if huge financial institutions are saying, maybe we need to protect some of our assets by going into commodities, that itself will, that massive liquidity injection post COVID is going to find its way into amplifying that price signal, won't it?
Oh, it sure will. Sure will.
Yeah. All right. So you mentioned that, part of what I guess it had the election gone a different way, you might have seen different prospects for how much the trade might aggravate. And then of course, lockdown was a big signal for you. How much of this, though, is explainable by just aggravating a natural commodity cycle? Is there a normal sort of like prices go up for X amount of years, prices come down for X amount of years, rinse and repeat cycle going on? Or is this just almost all these unique events of COVID and the response to it?
This is so Larry Fink can sell more funds. That's why the nation and the world are going through this. It's really very simple, Chris. There's one reason that the world is going through this crisis right now, and it's so that Larry Fink can sell more ESG funds. That's quite honestly the answer. It's due to greed, because he needs to sell more funds. If you've heard one of his most recent interviews, he said flat out to the journalist, whose name escapes me, a very popular establishment journalist, Sorkin. He said very clearly, you have to influence behavior, right? And so he's influencing behavior away from fossil fuels. Now, that's a nice platitude, and I'm going to rob a little bit from my friend Doomberg right now, but the reality is that fossil fuels is life, right? Fossil fuels are life. Energy is civilization, right? So we don't have to name, we don't even have to credit the last president. We can just say, look at what the world looked like while he was in office, supporting drilling and supporting the energy industry in the face of, who are now clearly a set of radicals in the government that were trying to just have that all squashed, right? So now look what you do. You make the conscious decision to say, okay, we're not going to source our power from $1.50 gasoline anymore. We're just not going to do it. It's the best way. It's the plentiful way. We have an abundance of it. It's the way any civilization would go about fueling their society, right? Larry Fink decided we're turning that off, because if we can pivot our energy source to wind and sun, then he can sell more funds. That's quite honestly the answer. So if he didn't have this investment idea, we wouldn't be suffering from this crisis, the food inflation, $7 gasoline, and any of it. So unfortunately, it's kind of one of these things where it's so virtuous and so delicious for the rich that they will literally look at this and say, we understand it's going to be very, very painful.
Did you see what, not Fink, but the president of BlackRock, I forgot his name. Did you see when he came out and said this generation is an entitled generation and they're going to finally see what it means to go to the store and not find something they want?
Yeah, it's because they know that they're creating this crisis.
Right. And I'm like, dude, the dude controls $10 trillion of assets, and he's lecturing people on being an entitled generation for complaining when they can't find food at the store.
Yeah. No. This is like peak American hubris, right? They'll be writing about this for, long after the empire ends, and it may end at the hands of, this type of unnatural forces in the world and in the markets, because when you're forcing value where markets otherwise wouldn't perceive value, what happens is you break natural ecosystems. right? You tear them apart and you tear apart natural relationships. And then obviously, also you can draw a direct line to the administration where we had no new wars and no real global conflicts going on. And now we've got this administration, and Russia decided to take Ukraine and make a mess of it. That situation brought forward a lot of the commodity stress, right? Because now we're talking about two nations that are huge holders of natural resources and suppliers of natural resources just between Russia and Ukraine. So now, you're going to take that amount of supply and put it under question or take it offline. And now you're basically, you're shifting the whole Rubik's Cube of the global commodity trade. And we're going to figure out, how to remake it. And, the genie is not going back in the bottle. And there's a lot of deflationists out there that think that this commodity spike that you see on the screen is the commodity spike, and that the forces of deflation will take over and there'll be some kind of, a quick resolution to Russia, Ukraine, and the technological singularity of it all will find a solution for energy, and we'll go right back to tech dominance over the world. And, my view is 180 degrees the opposite of that. I feel like we're going back to a hard asset renaissance where we're going to stop paying attention to computers and Silicon Valley and social media. And as you can see there, those sectors are suffering dramatically this year as commodity sectors have all taken the lead. And the difference is that the commodity sectors are worth 3 or 4% of the S&P, and tech is worth 30%. So if tech goes down, the S&P is going down, right? So, that's just a side story to continue, but to consider, but it directly dovetails off of this commodity trade, and where I think commodities are going to come really back to the center of the ecosystem, and we're going to go on another commodity super cycle like we've seen before.
Yeah, your point about commodities, your point about Russia sort of brings to my mind how if you look at like the ruble trading against the dollar, you see this war between the world of finance and the world of energy and commodities, where the world of finance thought that finance is all that matters and thought that they could just tank the ruble by saying, we're taking finance away from you. And then they reacted by, well, we're taking fuel and commodities away from you. And so you see the ruble just go down and then just go right back up. Well, and so that tug of war is that sort of like philosophical tug of war.
Well, with the conflict, the global idea was that the ruble was going to go to zero and, eventually devalue. But there's no way that, Putin knew that he wasn't going to devalue with the world's largest supply of natural resources. So all he had to figure out, he knows he's got Europe beholden to him for natural gas. So number one, he plays that card and says, you're paying in rubles now. There's a buyer of rubles. That'll help stem the slide. And then while we're over here, I'll sell you rubles for gold so that he can continue to collect gold and give out rubles. So he put a floor in the ruble, and it was, something that the West probably didn't expect. And now Putin can sell gas, sell oil at, $95 a barrel and finance whatever operation he needs to finance. So, there's a lot of moving parts to this, and it's going to be very interesting to see how it plays out over this year.
Yeah. You mentioned the term commodity super cycle. What is, can you explain what that is?
Yeah, we've seen these before, for example, in around 2000, when, it was a very similar thing where we saw the dot-com bubble crash. And in 2000, and during the same time, we saw China go on a commodity buying spree that sent commodities up and to the right for a decade. And what they were doing were collecting all of the aluminum and copper and steel that are in their military now floating around the oceans of China, and, the infrastructure that's now built in their cities. And so that commodity super cycle was just an astounding session of there being just constant buying, commodities trading straight up every day, prices going higher, inflation kicking in. And it goes on for a lot longer than anybody thinks can go on. because in at various different times, various fuses go off into different commodity shortages, and it continues to upset the entire global trade. So it seems like we're headed toward a similar situation again, but more driven. Well, what's really going on with this commodity inflation, Chris, that I think is worth mentioning is that this is definitely part of the reaction to the Fed doubling its balance sheet during the lockdown to save the S&P, for example. Right. So the Fed's balance sheet went from 4 trillion to 8 trillion essentially in one print. Our national debt went to 30 trillion. And so naturally what's going to happen is the value of your currency is going to devalue. But because all the other currencies are burning, what you're seeing is a broad currency devaluation versus hard assets. Right. And all of these currencies that are now so, like Michael Howard will tell you, held alive on liquidity, the world is saying, okay, well, we don't need as much of that anymore. We need hard assets. And it's kind of ironic how coming out of, the lockdown, which was another perfect situation for Silicon Valley, like we had in 2000 with this mania running into, all the .com stocks. So now we've got a situation where it was perfect once again during the lockdowns for technology, where everybody was home on their Apple phone, on Google, buying things on Amazon, entertaining themselves on Facebook and Netflix. So everything was perfect for those stocks, and they saw their peak. So it's no shock to a commodity trader that as commodities roar off the bottom, all of the money comes out of these technology stocks that were just, held sort of artificially at new highs with this earnings phenomenon from the lockdown that was like a windfall that they normally wouldn't have seen coming if they hadn't locked down the economy. So that's why this is such a powerful signal to me that we're heading into a longer frame commodity rally than a shorter frame.
I was working at a concrete plant in 2003-ish, 2004, and I lived through that. There were days where we had no steel to reinforce the concrete, and we would just sit there and do nothing all day, or we would, if we weren't salaried, we would just be told to stay home because China had bought all the steel and we didn't have any.
Yeah,
that's crazy.
Yeah. No, it's astounding. It's astounding. People don't realize what it's like until they experience it, right? Because, like we said, it's a very psychological phenomenon, right? If you go to the store and you see prices up 40%, your tendency, rather than to not touch it, is to buy more of it and say, whoa, this is going to be a problem, right? What if it goes up another 40%, or even worse, it's not here when I come looking, right? And then that's what feeds on itself. And what's going to be terrifying is that we've never lived through a severe inflation scare with social media. I lived through the one in the 70s, and that was all, newspaper driven and TV driven and, driving that impulse. And so now we're going to see what it's going to be like with social media driving that impulse. So it's going to be a little bit hairy.
Yeah, I mean, social media is a great amplifier of psychology, and if psychology is an amplifier of price, then that's
right?
scary.
Yeah.
So, all right. So this thing with tech, I guess, I mean, obviously there's sort of like numerous themes here. Like if you're at home on Netflix and lockdown, you're not building anything, obviously, and so there's that tug of war. But is this also related to like just how people are valuing assets because the inflation are tech and commodities like direct opposites in that for finance reasons in terms of how they're valued?
Yeah, well, it's worth noting again that coming into this year, technology was 27.5% of the S&P, right? Coming into this year, energy was 3% of the S&P. So, these stocks have, and that's down from in the 90s when ExxonMobil was the biggest stock in the Dow, and energy was, the lifeblood of the nation, and we were heading toward another energy renaissance. Energy was the biggest weight in the S&P. And then we saw, shale production come on, and we saw the great, the oil crash in 2015, and that sort of rearranged the checkerboard in the energy space and sort of devalued it to a much lower price and, kind of absurdly valued everything out of Silicon Valley. So I think that, that's where, then you've gone with this is sort of financial separate story, but with the growth of passive investing, that really exacerbated the growth of the biggest stocks in the market, which are Apple, Google, Microsoft, Amazon, Facebook. And so that kind of exacerbated the technology rally in and of itself. So now the whole world is invested in all of these names and underinvested in the commodity space. So it's my bet as a trader that, at the end of 5 years from now, that I would imagine that you see them diverge and you see energy, and commodities being valued a lot higher in the S&P and, and generating a higher weighting, and technology just, backing off and off and off and generating a much lower rating than we've seen.
Yeah. And if that's true, then that's going to make more investors want to increase commodity and decrease tech, and the passive flows, they just follow momentum, right? So they could turn to amplifying that trend.
Yep. $1 in means buy more energy, right? Yeah. $1 out means sell more tech, and kind of that's the way, first of all, this year is panning out with, oil stocks, mining stocks, natural resources stocks, gold miners, all positive on the year, up 25-40%. And home builders, social media, internet stocks, semiconductors, cloud storage, and software off 15 to 25% on the year. Right. So that's telling us the story right there, what's being valued and what's not right now. And my bet is that type of rotation that I've called the Great Rotation is going to continue for a decade.
So I think that the sort of dominant view in the market right now is that the Fed's going to withdraw liquidity, raise interest rates. We're going to go into a great recession risk. The Fed's not ever going to be able to keep raising rates. They're gonna have to save us from that recession, and then they're just going to blow the tech bubble back up. What do you think of that? I mean, obviously you think it's wrong, but
no, I think the Fed is going to remain behind the curve, and unless they raise rates higher than inflation is going to rage on, right? So they're not going to be able to do anything to stop the commodity rally. They're not going to be able to do anything to stop a food crisis. What they'll wind up doing is borrowing more from the Treasury to send more stimulus checks out and call it the food and gas grocery bill. That everybody will get another $400 or $1,000 check to put toward the rising price of everything, which is therefore going to exacerbate the rising price of everything.
Right.
So,
right.
And this is really, really sort of where it's going to be cool to wake a lot of the people up to how destructive central bank policy is, and sort of what that really means on a day-to-day basis. And, luckily, because we've still got probably a more powerful army and navy than most other countries, we're still the reserve currency. But if that changes, then we're at serious risk of a devalue, and that will definitely wake everybody up. But that's a really ugly situation I don't want to talk about.
Yeah, no, I mean, there's lots of silver linings here. Like even from a food perspective, I'm very interested in how regenerative agriculture that is less dependent on fossil fuels and chemical fertilizers produces higher quality food and could make us more resilient. And yet I don't want to get there through a global famine.
Right. But, yeah. Exactly.
So what I guess, and you can sort of answer this from a trader perspective or and however you want, but as a trader, you must have things that you're looking for what would be the sign that I'm wrong. And you must also have, even if it's years out, things that you're looking for this is my signal for my exit strategy. I'm wondering if we can borrow a little bit from how you see that for the person who just wants to plan, like, do I need 2 years worth of food, or do I need, what are the signals that you would look for that this is going to reverse course, whether it's either because thank God it's not as bad as we thought later this year, or if it's, in 7 years, I'm looking for these things to start turning around. What would be the early signs of a turnaround and the confirmatory signs of a turnaround that we should look for?
Well, first of all, it's important to make the distinction between the commodity trade, pulling back, and the sort of, the food inflation being solved. right? They are related, but there are things. There is a scenario where commodities can pull back a little bit and probably maybe take some heat off of this rally, but it's still more likely that we're suffering from massive inflation either way, right? So the signs that would reverse this, so far, there have been really great signs glaring in the opposite direction, which have been awesome for traders. But the signs that would prove me wrong are if the administration backed off of the transition to electric vehicles, or backed off the transition to carbon neutral. And what's been amazing is that they not only back off, but they continue to try to institute the impossible, where we're going to be, they start to institute the next policy, which is, okay, the next policy is going to be every company with a carbon emission is going to have to quantify it. Then they're going to have to quantify the carbon emissions that come from their suppliers so that we can get this big giant matrix. And then when they ask Jen Psaki on TV what's going on with food inflation and the price of gasoline that the administration undoubtedly caused on purpose, and she says Putin did it. So for traders, that's like the most amazing thing in the world. That's like, oh my God, buy more oil. Like they won't even let on to the fact of what they're doing, right? They're actually driving the price of oil higher to make it make more sense. Listen to Transportation Secretary Pete Buttigieg. What does he say? Come on, man, the gas price wouldn't be a problem if you had an electric vehicle, right? So just drop that 80K down and you have no problem with $5 gas because you won't be paying it, right? He doesn't acknowledge the fact that even the electricity going into the car costs are going up 2 and 3 and 4x on the way to pushing the vehicle on you. Right.
And Tesla's, I don't even think Tesla's meeting their quota for, the fuel to use to mine the metals for the batteries. If everyone
they're not meeting any of the quotas, right? They're not meeting the quotas on the batteries. They're not meeting the quotas on the cars. They're not meeting the quotas on anything. So, that situation is really hairy. And then when you've got the energy secretary that piles on Ms. von der Leyen and says the same thing, well, sorry about the high gas prices, you can go buy a Tesla, right? And so that this is the administration saying, we don't really care what happens to the people in this transition. We're here because Larry's got a great lobbyist, and his lobbyist tells us no more gasoline. Buy the solar panels from China, buy the metal for the batteries from China, and power your car with wind and solar. And we're sorry that the wind doesn't always blow and the sun's not always out. Deal with it.
Yeah, I'm very worried that if I could take this in an even more cynical direction, that this is sort of like the end game is that no one will be able to make a productive living, and therefore everyone will depend on government stimulus checks, and those stimulus checks turn into people talk about UBI, but I think of it as CBI, conditional basic income, where whether your vaccine status or like what you said on Twitter, or like when the facial app asked you some question and like, can men get pregnant too, and you have the wrong answer, or the facial app recognition sees that you had the right answer but you had too much of a smirk when you did it or something, like docks your stimulus check.
Right.
And anyway, right. So are you? It sounds like you're seeing this as not so much from like on a long-term perspective, not so much for looking like at a little tick up and down on a trend line, so much as you're looking at this like, when I see a total 180 in the political dialogue around fuel, then I will start to plan my exit strategy. Is that how you're thinking about it?
Yeah, I think so. Yeah, good.
And so from like a food perspective, it seems like you would need a confirmed reversal of that, and then at least wait a year and a half out for the next growing season from the fertilizer produced from that fuel with that lag. And so it seems like, from your perspective, when we see the political 180, then we can say food prices might start to come down in a year and a half from now if this is sustained. Is that how you see it?
Probably not that fast. No, no.
How fast?
Well, first of all, it would take 5 to 10 years before gasoline prices come down with the destruction that the administration is wreaking on the industry, right? Like they're to the point where they're making it uncomfortable for the E&P companies to hold drilled but uncompleted wells on their inventories, right? So what a drilled but uncompleted well is a well that's already in the ground that when you need supply, you drive the rig over to it, you plug it into the hole, and you get oil, right? The administration is making it more expensive and difficult politically to carry these drilled but uncompleted wells on your list of inventory items, right? So what we've done is we are closed the list, the chart of drilled but uncompleted wells is a collapse, right? Down to blowing through historic lows of drilled but uncompleted wells here in the nation, right? So what's going to first have to happen is that we're going to have to get, like, when they finally decide to reverse policy, we're going to have to round up the troops first and get the drills back in the ground on the federal leases, right? That is not going to, get oil onto the markets for another 2-3 years, right? Maybe at least a year and a half, at more likely 2 to 3, and more, and until that adjusts things closer to normal, you're talking about 5, right? Because you need a couple of years of that added production just to, create the excess capacity to get the prices back down. So the thing is, politically, one of the signs for me that my trade will be getting close to over will be, when starving Americans are marching on their local government, or, there's unrest in that vein, then, maybe you're going to see that a response is going to have to be, okay, we're going to do some drilling to try to help the gasoline price come down, right? Because releasing the SPR, which Biden has been doing, is nothing but weakening the United States as a country and empowering China as a country. That's just a binary trade. That's what the SPR release does. And so I feel like that's maybe why he's doing it, because I feel like he's okay having China more at the center of the global universe and the U.S. as a much less powerful country, because we're going to now pivot and buy that same gasoline, it's the same oil at some point from people that don't like us for $200 a barrel. Right. So that's not a question. That's probably, that's the way that's lining up right now. So, and now he's, spilling out almost the rest of the Strategic Petroleum Reserve to exacerbate the issue. So there's so much that has to happen politically. And even at that start, so what'll happen, Chris, is that the markets will start adjusting and prices will cool off of their highs, and they'll find a range. But if you want to look back to where we were during the Trump administration, we're not going back to those prices for 10 years. That's gone. That's over. The thought of that is the thought of $2 gas is over until 2030, period.
Well, we know what happens then. We own nothing.
Right, exactly. And we like it, and we're eating bugs and the whole thing. So.
All right. So we're looking at 7 to 10 years after we see some kind of fundamental, sustainable political transition. All right. So last question for you, and we don't, we don't give financial advice here, but I just want to get your, your perspective for the person who's listening to this and is worried about the next 10 years, knowing what but if you, weren't looking at the Bloomberg terminal screen all day and wanted to, park your savings somewhere safe for 10 years, what would you be thinking about from if that were you, how would you be thinking about that?
So a couple of ways to be smart about this, Chris, is number one, I think it's smart for people to, check any portfolio that they have and make sure that they're out of the way of technology stocks. That I think is the first thing, is to if you've been fortunate enough to be long technology for any part of this unbelievable bull run in the last 20 years, it's time to be less long that trade. Because if interest rates are going higher, then growth companies are going to suffer dramatically because they can't finance their operation with cheap cash anymore. So those companies are going to be in the crosshairs from investors and traders. So I would get out of the way of that first. And secondly, you want to have commodity and natural resource exposure in your portfolio, which I would think, is some combination, along the natural resources tree of, something, maybe gold to preserve your savings, maybe something energy based and something metals based, and to sort of have some exposure to hard assets. The sort of barbell that I've been recommending and that I trade actively are 3 ETFs, and one is XOP, which is an oil and gas ETF. One is IGE, which is a natural resources ETF, mostly energy, but also has some mining and a lot of materials companies in it. And then XME, which is all industrial metals and mining. And these are the mines of the base metals like aluminum and copper and zinc and all the thing and nickel and all the things that go into electric batteries, where we are at historically low supplies and historically high prices. So that to me seems like a good way to make sure that I'm participating in a myriad of hard asset investments.
All right, thank you so much, Tony Greer, for taking really important time out of your workday for this. Where can people find more of your work, and where should they follow you?
Yeah, you bet, man. I'm on Twitter at TG Macro. You can find me if you want to email me, anybody that's watching this, you can find me at tony@tgmacro.com. It's fine to reach out there. Otherwise, my website is tgmacro.com, and there's a list of my background and, how I started, the products I started, and I publish a newsletter, and I offer some other more premium services to my investing clients as well. All of that is well spelled out on the products page of my website. That's
Awesome.
pretty much it, man.
Awesome. Thank you so much, Tony. This is great.
Chris, thanks for having me on. I really appreciate it.
Have a great day.
You too, man.